8 times a year, one event has the potential to move stocks, bonds, currencies, and volatility at almost exactly the same time. That is, of course, the Federal Reserve interest rate decision. Now, we all know markets can move sharply when the decision is announced, but what happens afterwards? Does the market simply absorb the Fed news immediately, or is there a recurring tendency for prices to continue moving in the hours and days following an FOMC, Federal Reserve decision? And that's what we're going to investigate today, the idea of a post-FOMC drift. Now, there are already substantial research that's been conducted into the relationship between Fed meetings and equity returns. One very famous finding is actually the pre-FOMC announcement drift. That was researched by David Luca and Emmanuel Munch, forgive the pronunciation if it's wrong, at the New York Fed. They found unusually strong average US equity returns during the 24 hours immediately before scheduled FOMC announcements. And I think that was in a sample that extended, if I'm correct, from 94 to 2011. Now, today we're interested in the other side of the event. What happens after the Federal Reserve announcement? And this gives us a very simple hypothesis to test. Does the S&P 500 display a recurring pattern immediately following FOMC meetings? And if it does that effect extend beyond equities? Because a Federal Reserve decision, of course, doesn't just affect stocks, it's impacting interest rate decisions. So it impacts Treasury yields, the US dollar, major currencies, and volatility. So let's start with the S&P 500 that's here on the screen. Now here I want to use Seasonax to isolate the period immediately following historical FOMC decisions. So what we're going to do here, this is the 2 days following an FOMC decision. You can see that the average return is 0.24%. There's a winning trade percentage of positive 5.750%, but the average return is negative. The standard deviation is 1.72%, relatively low, so there does seem to be a consistent response. And the maximum loss on occasions, can be over 4%. You can see maximum falls of 4% 2018, 2020, 2022, and then falls of over 3% in end of 2022, middle of 2024. So what that tells us, the average is negative. So there is a general drift of bias to the downside in the 2 days after the Fed meeting. But look at the 2 days to 10 days after the Fed meeting. You see then there is a drift to the upside, nearly a 70% winning trade percentage, an average return of 0.88%. And then you're seeing gains biased to the upside, standard deviation 2.50%. So a fairly consistent pattern with a bias to gains, and there's a number of years when the gains are around 5% here, 2016, 2020, 2022, etc., etc. So why would a drift exist? Well, there's a good reason to investigate this period after the announcement, because a Federal Reserve decision is much more simply than whether the Fed raises rates, cuts rates, or holds interest rates. Markets will also have to digest the statement. If you take a look here, particularly when you're looking at the monetary policy report here, you're looking at the dot plot. And in that, the dot plot, you are looking at a whole range of different projections from the expected inflation path, the unemployment rate, the projected path, GDP, as well as interest rate projections going 2028 in this instance and beyond. So, 2, 3, 4 years into the future. So that's partly why you get this drift existing as markets are digesting and processing multiple pieces of information, not just one single interest rate number. And that potentially gives us a mechanism through which repricing can continue, after the initial announcement. That's why you're getting these kinds of things happening. Now let's see if we can see anything similar in other markets. Of course, we'd expect a reaction here in the US Treasury yields. Now, this is again looking at the Federal Reserve interest decision, and look at the 2 days after the Federal Reserve decision, and you can see the bias is for yields to fall, right? There is an average return of 0.34%. This is the yield, so that's US Treasuries being bought, and of course that's very interesting to see that bias. And then again, from the 2 to the 10 days after the Fed interest rate decision, you've got the US Treasuries yields moving higher. So typically, right, you'd expect that the dollar should strengthen after FOMC decisions if you've got yields going up from days 2 to days 10. So let's have a look whether that is the case. We'll go and have a look here at the dollar. This is the euro dollar. So we'll just change it to the Dixie to make it clearer. The euro dollar is like the anti-dollar index, but we'll just look at the Dixie to keep it in line with the yields. And there you go. You can see, look, there's this bias for US 10-year yields in the first like 2-3 days after the Fed decision to move higher, 0.27%. Then interestingly, from day 2 to day 10, where you'd expect it to move up, actually, it's moving lower. So post-FOMC decisions, that's surprising, that actually, even though you've got yields for the US 10-year yields, if you just take a look at them post-Fed, you've got yields moving lower, so a bid into bonds. If you look from day 1 to day 4, look, okay, that makes more sense. 1.23% average return, 10-year yields going up. Then if you look day 1 to day 4 on the dollar, yeah, okay, you've got a positive average return in the dollar. But interestingly, the dollar strength tends to come earlier, first couple of days and the first 3 days. Finally, let's look at the VIX. This is the so-called fear index, which is the proportion of put options in the S&P 500, and a rising VIX is seen as increased fear. So let's look at the 2 days after the Fed decision. You can see the average return is 0.52% to the upside. Although when there is a fall in the VIX, it can be really quite marked after the FOMC decisions. And look at the standard deviation, 13.66%. So it just means that the kind of reaction in the VIX is much more varied than some of the other instruments we've looked at. So how should traders apply all this data? Well, first of all, identify the FOMC meeting as an event window, right? So recognize that when you come into this FOMC decision, the time before the meeting and the time after the meeting is a definite event window. And secondly, examine the historical behavior of the particular asset you're trading. So for instance, if you're trading the dollar index, notice, look, there is a predisposition for the dollar index to gain after on the 2 days after a Federal Reserve meeting. So combine that then with what the Fed actually communicated. So for instance, if the Fed communicated a more hawkish stance, that interest rates were expected to rise more than expected, if inflation expectations were revised higher, and if unemployment rates were made the same or lower, and you'd expect that to be very supportive of the dollar. And you can see here, look, over the last 5 years, some of the biggest gains in the dollar on the 2 days after the Fed decision have been, up to about an absolute maximum stretch, 1.5%. So if you were trading, that decision intraday, you could see, okay, if I hit gains in the dollar of over 1%, that would make sense for profit taking from a historical perspective. And if you look at the move of the dollar index over the last 10 years, 5 years over the last 10 days, you can see there's only 1, 2, 3 occasions where it's hit more than 2%. So post-FOMC drift is therefore a great example of why event seasonality needs to be tested rather than assumed. We know the Federal Reserve has an unusually important influence on financial markets, and recent Federal Reserve research continues to find that Fed communication has substantial effects on stock prices through yields, risk premia, and expectations. But whether that creates a reliable post-FOMC seasonal pattern is a different question. And that's where the data comes in, and that's where Seasonax can help you see historical moves in these key instruments impacted by the FOMC. Remember, don't just trade it, Seasonax it.